Hey everybody, welcome back to Retire on Dividends. It's Jordy here, and today I want to dive into something that's been on my mind lately, especially as I look at my own portfolio and what's been happening in the market over these first few months of 2025. If you've been with me for the past few episodes, you know we've covered a lot of ground from the major changes to SCHD's holdings in episode 1 to Boglehead principles in episode 2, Bitcoin integration in episode 3, and most recently, my realization about using yield max ETFs properly in episode 4. Today, I want to talk about something that might be a little controversial for dividend investors, but I think it's important, diversifying beyond SCHD in 2025. Now, don't get me wrong, SCHD is still a cornerstone of my portfolio, but if you've been watching the markets lately, you know SCHD has been underperforming compared to other funds and even within its own category. Let me start with a quick personal story. When I first started dividend investing, I was like a lot of you. I found SCHD, fell in love with it, and basically built my entire dividend strategy around it. The combination of dividend growth, quality companies, and low expenses was perfect. I'd put money in, watch those quarterly dividends roll in, drip them back in, and repeat, simple and effective. But over the last couple of years, especially in 2023 and 2024, SCHD started lagging. And now in early 2025, we're seeing the same pattern continue. When I checked the data recently, I was shocked to find that SCHD has fallen from consistently being in the top third of Morningstar's large value category to now being in the bottom quarter or worse. The crazy thing is, investors are still pouring money into it. It's grown to almost an $80 billion ETF. That says a lot about how much dividend investors trust this fund, myself included. But here's the thing, as I've grown as an investor, I've learned that adaptation is key. No single strategy works perfectly forever. Markets change, economic conditions shift, and what worked amazingly well for the 2000s teens might not be optimal for the mid 2000s 20s. Let's talk about why SCHD has been struggling lately. The biggest factor has been its underexposure to the mega cap growth stocks that have been driving the market. While the fund focuses on quality dividend payers with strong fundamentals, it's missed out on the massive tech rally we've seen. When I looked at SCHD's latest reconstitution, I noticed they even dropped Broadcom, not because it cut its dividend, but because its yield fell to 1.2% after its stock price soared from the AI boom. This highlights one of the limitations of dividend focused strategies in certain market environments. Some of the best performing companies reinvest heavily for growth rather than paying high dividends. And so, what's my approach now? I'm calling it the core and satellite dividend strategy, and it's working well for me this year. SCHD still makes up about 15 to 20% of my portfolio. It's a core holding that I continue to believe in long term. But I've diversified my dividend approach with these satellite positions, VYM, Vanguard High Dividend Yield ETF. This gives me broader exposure with over 400 holdings compared to SCHD's roughly 100 companies. It's less concentrated and provides some different sector exposures. DGRW, Wisdom Tree, US Quality Dividend Growth. This fund focuses more on future dividend growth potential rather than current yield, which has helped it capture some of those growth-oriented companies that SCHD misses. DGRO, iShares Core Dividend Growth ETF, similar to DGRW, but with a slightly different methodology. It requires only 5 years of dividend growth history instead of 10, which allows it to include some younger companies with strong growth trajectories. A small position in SDVY, First Trust SMID Cap Rising Dividend Achievers. This gives me exposure to small and mid-cap dividend growers that aren't found in the other ETFs. The average market cap of companies in this fund is only about $2.3 billion. Now, I'm not suggesting you should dump SCHD, and far from it. What I am suggesting is that in 2025, having your entire dividend strategy in just one ETF might not be optimal, no matter how solid that ETF has been historically. Think about what we discussed in episode 2 with Boglehead principles. Diversification is key, and sometimes that means diversifying not just across sectors and companies, but across different dividend investment methodologies as well. For those of you who've been following along with episode 4, where I talked about yield max ETFs, this fits right into that philosophy. I explained how I was using yield max funds all wrong by expecting them to provide reliable retirement income when they're actually better suited for tactical positions. The same principle applies here, understanding what each dividend ETF is designed to do and using it accordingly. Here's how I think about it. SCHD is like a reliable Toyota, or not flashy, but dependable and efficient. But sometimes you need a truck for hauling, or a sports car for performance, or an SUV for bringing the whole family along. Different vehicles for different purposes. When I made these changes to my portfolio earlier this year, it wasn't easy. I had to overcome that psychological barrier of moving away from what had worked so well for me in the past. But I kept reminding myself that the best investors adapt to changing conditions. So, what's my approach going forward? I'm continuing to dollar cost average into all these positions with a slightly higher allocation to SCHD. When it dips significantly, I still believe in the fund's methodology of selecting companies with strong financials and dividend growth histories. And if market conditions shift again, say we get a recession or growth stocks fall out of favor, SCHD could very well outperform again. The key insight I want to leave you with today is this: dividend investing isn't just about chasing yield or sticking with one strategy forever. It's about building a resilient income stream that can weather different market environments. As I always say, I'm sharing my journey, not giving financial advice. Your situation might be different from mine. Maybe SCHD is still perfect for your needs, or maybe you need an entirely different approach. The important thing is to periodically reassess your strategy based on both changing market conditions and your own evolving financial goals. Before I wrap up, I'd love to hear your thoughts. How are you adapting your dividend strategy in 2025? Are you still all in on SCHD? Or have you been diversifying like me? Drop a comment below and let's learn from each other. If you found value in today's episode, please hit that like button and subscribe if you haven't already. It really helps the channel grow, and I appreciate each and every one of you who takes the time to engage with this content. Until next time, this is Jordy from Retire on Dividends, and I'll catch you in the next one.